I've been seeing a lot of advertising around reverse mortgages lately on television and ads, and they have a lot of celebrities, well-known people as their spokesperson. Here in Canada, I see Kurt Browning is a spokesperson for one of the companies, and Tom Selleck in the United States. And this made me begin to think, what is the value of reverse mortgages and who would they best be suited for? And so in this video, I'm going to take you through the basics of what a reverse mortgage is, and the pros and cons of each, and ultimately who would be best suited for a reverse mortgage. Hi, my name is Deirdre Dunn. I'm a real estate broker here in the Wellington and Waterloo regions of Ontario. I help empty nesters downsize, removing the stress, the anxiety, the overwhelm by using my 5-step method I call your next chapter. And if you find this video really useful and informative, at the end, if you could press the subscribe and like button so that more people like you could see it, that would be awesome. So let's begin. What's a reverse mortgage? Let's start with that. So everyone's, I think, most familiar with a regular mortgage. You go to a bank, you give them your financial information, and they lend you money to buy a house. Well, a reverse mortgage is exactly the opposite. You already own a house and you want to take the value or the equity out of that home so that you can use it and spend it the way you want. You can take it in a lump sum, you can take it in monthly payments, or a combination thereof. But that's what a reverse mortgage is. Who is a reverse mortgage sort of targeted to or best suited? Well, definitely retirees, aging homeowners, people who don't have a regular income and can't qualify for a regular mortgage, a home equity line of credit called a HELOC, or even an unsecured line of credit. And the reason they can't qualify is because banks are very particular about how they want to see your income. And they want to see earned income so that you can make the regular interest payments. And retirees don't have regular incomes. So banks don't really like retirees. So that's where reverse mortgage fills that gap. You're retiree, you do have wealth, you do have a retirement income, but it doesn't fit the bank's definition. And yet here you are sitting in a home with equity, and you want to access that equity. A reverse mortgage does exactly that. So who in Canada offers reverse mortgages? It's two companies. I always get their names confused. Home Equity Bank and Equitable Bank offer reverse mortgages here in Canada. Now, there's basically 4 criteria that you need to have to qualify for a reverse mortgage. Number 1, you have to be 55 years or older. 2, you have to own your own home. 3, you have to be a Canadian citizen. And also the location of your home becomes very important because, believe it or not, reverse mortgages are not offered everywhere, and I'll get more into where they are more likely offered than in other places. So as I mentioned, reverse mortgages, you can take out a lump sum, a monthly amount, sort of like an annuity, or a combination thereof. And just think, reverse mortgage, if your house is worth $1 million and you take 55% of that, that's $550,000, versus if you're in a $600,000 home, then that's going to be a smaller amount. So how do payments work with reverse mortgages? Well, they are actually just like a regular mortgage. They have fixed terms and variable terms that you can choose from, and the fixed are like 2, 5 term years that you can choose from. Be aware, though, that the interest rates are higher with reverse mortgages. The reason the interest rate is higher is because they're secured against your home, but the lenders aren't getting paid regularly like they are with a regular mortgage. So that ties back into earning a regular income and all of that. Also, reverse payment happens when you sell the house or upon death. Interest calculation is compounded, and it's compounded differently if you have a variable versus a fixed. So a variable, it's compounded monthly. Fixed, it's compounded semi-annually. So how does that work? Well, let's say with a variable, I'll use a very simple math calculation here. You have $100, it's 5% interest. and a variable. So the first month you owe $105. The second month they take the 105 and they add the 5%, and now it's $110, and so on. So each month the interest gets added on to the total, and that total is used for the next calculation. So imagine having a variable rate mortgage for 5 years and it's in the 7 to 10% range. It can add up quite a bit. That's why they only allow up to 55% of your value of your home, because they want to make sure that when you sell your home, the mortgage isn't higher amount than the value of your home would be. And for a fixed mortgage, it's compounded semi-annually, just like a regular mortgage. The other thing you should be aware of is reverse mortgages actually do daily calculations. So I know I mentioned that like a variable, it's a monthly and then that month, but they actually calculate that based on a daily amount, which may sound like we're only talking pennies difference or quarters difference, but over the long term of a mortgage, those little bits of difference, meaning a little bit more, actually owe more at the end. So just be aware of that. So what are the pros? Well, the pros are that you can take a value portion of your home's value and get access to it in cash, which is an awesome idea. Also, there's no monthly payments like a regular mortgage. So again, it doesn't affect your regular cash flow. And in fact, you can infuse this big lump sum or a monthly payment into your regular cash flow to supplement your retirement living. And it works better, I believe, for someone in their really later years. Because imagine if you're 70 and you live to 90 or 85 and you have a reverse mortgage for 50 years, even out of several fixed terms, that's a large amount of interest that you're going to be paying. But let's say you're in your late 80s, mid to late 80s, and this is going to supplement your care or your living expenses, then it's probably better suited, simply because the amount of time that you're going to have that reverse mortgage will be less. And it's also unlikely that you're going to have a reverse mortgage larger than what your home's value, because again, it's only up to 55% of your value. So here are the cons I see with a reverse mortgage, and I think there's several of them. I mentioned already interest rates, and I think this is one of the biggest reasons where reverse mortgages are not always applicable to everyone. So I looked up the most current reverse mortgage rates, and right now they're 7.9 to 10.3% interest rates. I just got a home equity line of credit on our primary residence, and it was 7.45. So already it's higher than a regular home equity line of credit. And why is that? It's because I've mentioned already, retirees don't have an income to pay that monthly interest payment. So the banks are saying, listen, we're not going to get our money until the end, so we're going to add a premium onto that loan rate, so that it makes us worth the bank's while to wait to get paid sometime in the future. And that future could be 2 years, 5 years, 10 years, 15 years. So that's something to keep in mind. Also, when you have a reverse mortgage, just like a regular mortgage, it's a lien on your property, meaning it's a legal claim of an unpaid debt. So that goes and gets registered against your home, so that the reverse mortgage company will be paid. And I should mention that reverse mortgages are most often dealt with through a mortgage broker or a mortgage agent. They're the most common sort of source for reverse mortgages. The other is there's going to be an appraisal cost, and you're going to pay for that, and that's anywhere from $400 to $600, and that's always paid upfront. You're going to need an ILA, which is independent legal advice, depending on your age. And the reason reverse mortgage companies have you do that is they want to make sure that the person truly understands what they're getting into, the financial and legal commitment that they're making when they're getting a reverse mortgage. The other thing is that there's, depending on the company and fixed or variable, there are startup fees. Now, sometimes these fees can be added into the amount of the reverse mortgage, so they're just added on, but often you have to pay those upfront setup costs before you get your reverse mortgage. So there are fees. It's not in a totally free kind of way to get money up front. And you must keep your home, the property taxes paid, the maintenance, and home insurance up to date when you have a reverse mortgage. So you can't let your house, get really run down. And I couldn't find any specific definition of what means maintain maintenance, but I would think it would mean just basic maintenance. The lawns cut, things shoveled, if the roof needs replacing, you'll have to do that, things like that. So those are the three criteria. Also, I mentioned earlier about where you might or might not get a reverse mortgages. So Quebec, Ontario, BC, and Alberta all offer reverse mortgages. They have companies that do that. And they're all in urban or large centers. So if you live in a very rural area, even if you're in Ontario, you may or may not qualify for a reverse mortgage. So that may be a drawback regarding a reverse mortgage. The last thing is when you payment of the reverse mortgage. So I said when you sell the house, what happens if you die, pass away, and there's a reverse mortgage on your home? Then your estate is responsible for payment of that reverse mortgage. But it may be a challenge for your executors or administrators to pay, because if the will has to go through probate, and that probate takes many months, and in some areas it does take many months, but the ownership has to be, that debt has to be paid off sooner. So that may be a real challenge for your administrators, estate administrators, to manage getting that debt paid off, and somehow sort of making everything all clear for your estate. So I think after looking into a reverse mortgages are really a tool of last resort. So you can't get a regular mortgage, you can't qualify for a regular home equity line of credit or an unsecured line of credit. So reverse mortgage is kind of the last resort. I wouldn't recommend for someone that it would be your first choice to go and look at it. And I think also in your later years, a reverse mortgage makes much more sense than, let's say, being 55 or 60 and getting a reverse mortgage, unless it's for a short term. So you're using the equity of your home, let's say, to redo your kitchen, update your house so that you can sell it. It's a way to get equity for a short term, and then you just build in that cost when you sell the home. But if you're getting it at 60 and you're not going to pay it off for 15 or 20 years, that's going to be really expensive. And there is a potential, but very unlikely, but there is a potential that maybe there won't be much equity left in the home. Although I know I mentioned that it's up to 55%, but what if over that very long period you happen to sell when the housing market has really dipped? And so you thought, it was going to go up like this, and it's gone up and maybe come down at the time that you sell. And so you thought that it's all going to work out. So reverse mortgages do have a place. It's just not, I don't think it's for every retiree to consider. So that's reverse mortgages. Thanks for listening. And again, if you found this information useful, please hit the like and subscribe button. Really appreciate it. See you in the next video.